We made it. It's the end of the week, nearly. We're nearly there, folks. A long, hard week, and we're nearly there. Good morning, everyone. Good morning to the two boys, Kay and Stel.
Hello, good morning.
PGIF. Happy Paddy Day.
Happy Paddy's Day. Everyone celebrates Paddy's Day. No one celebrates St. George's Day. It's disappointing. More people in the UK celebrate an Irish holiday than they do, or an Irish Saints Day than they do an English Saints Day. Always amazes me that. But then I suppose everyone likes a beer in an Irish pub. Do you know there's probably more Irish pubs around the world than there are any other bar? Do you know that fact?
No.
How many of them are really Irish? That's the question.
Pretty much all of them, actually. I say this from experience because on every football trip, holiday, stag do, you name it, I've been on, there's always been an Irish bar. In every country, there's an Irish bar. It's amazing.
Yeah, I know. They were like, there's a legion of Irish bars in Tokyo as well. Exactly.
Everyone knows the Irish likes to drink, and that's probably why. And yeah, who's saying that, Brian? Like whole cities of drunk people. Yes, exactly. And if you've ever been to Ireland, the true is there as well. Lovely place, Ireland. Anyway, enough of drinking. That's for later on when we've really, truly had enough of trading. And we can all clear off down the pub, or at least hit the drinks cabinet for those that work at home. Lots to get through today, this morning. So let's kick it right off with a rate cut from the Chinese central bank. They pulled a bit of a rabbit out of the hat and cut the reserve requirement ratio by 25 pips this morning. Didn't really have the impact it used to, pretty much because it had been touted for quite some time that an RRR cut would potentially be coming. Some were saying end of Q1, some were saying Q2. It's close enough, but they've gone ahead and cut those rates there. In bygone days, you might have seen Aussie, a key currency, moving 40, 50 pips on rate moves from China. We barely got 20 pips out of it on this one. So as I said, that's pretty much showing the market was expecting it, not really much of a move anywhere. No move even really in dollar China. It was floating down near the lows. It did have a little bit of a rally up, but in the grand scheme of things, not really anything to write home about for that one. The market is largely taking it as a positive move, that it will help spur growth from all this cash that is now able to leave banks, safety boxes, if you like, and be put to use in the economy. So we shall see over the coming months whether that bears fruit. Over in Japan, BOJ's Kuroda was in Parliament. Not sure the context of some of these comments, but he was talking about negative rates and the like. He said he can't say how far negative rates can go in theory, and believes there's still space to go lower beyond the current minus 0.1%. He says it's hard to lower medium and long-term interest rates by deepening negative rates alone. So on one hand, some could call them dovish comments, but again, the context matters with this one. Could have been talking about things like the policy framework and how much they can do. What the government and Bank of Japan do with that policy framework is potentially up for discussion once Ueda gets in the hot seat, as to whether they change things around, inflation targets, so on and so forth. Again, stuff that we need to wait for. In the wage talks, one of the big unions, Rengo, said that overall wages will rise to 3.8% in pay talks. That's coming in higher than the 3% the Japanese Center for Economic Research touted yesterday. A bit higher that was than the 2.8% expected before. So maybe we're getting into some higher numbers than expected from these wage deals. Not that you would know it much movement in yen pairs with everything else going on. Kay, we spoke about this yesterday. 3.8% maybe towards the higher end of expectations, but still seemingly lagging behind inflation unless we suddenly see inflation pulling back?
Well, 3.8 should, in theory, put it above the what is expected anyway to come out as inflation, because there's already a lot of writings about inflation will come down again because of stimulus package, whatever. We know that the Japanese government has been putting in place a gigantic amount of stimulus as well. And yeah, I was quite surprised because when the 3.8 hit the wires, dollar yen actually went up 30 points, and that's a bit counterintuitive to what we may have expected on any decent wage rise, because that would put it well above Kuroda's 3% mark, right? So I'm a little bit I'm puzzled, but I think yen right now is really trading risk again, and there's so much going on in the yields environment. It's really tough to see the forest right now. There's too many trees in front of it. And,
yeah, no.
And so I think it's 8th or 14th of April that the official handover takes place, and then end of April we'll have the first meeting with Ueda. So in the meantime, as I've already said, we are end of March now, and we are going into the end of the fiscal year in Japan. So there may be flows popping up left, right, and center of stuff that they just have to do before the fiscal year, and so it may all be a bit of a blur in the yen until Ueda effectively takes office.
Yeah, and I guess we've got to watch the Gatobi fixes with a bit more
Absolutely
focus. And for those that don't know, the Gatobi fixes happen every 5th day, so 5, 10, 15, 20 of the month.
The major ones usually are the 5.15 and the last one.
Yeah.
And let me quickly look at.
That'll be the 30th, then, won't it?
30th is on a Thursday, so that's going to be an interesting one. 30th, 31st, last fixing of the month on a Thursday and a Friday. Yeah, but it could get a little bit wild in the end those 2 days.
Yeah. And what time? Just remind us of the time of the Tokyo fixes.
Actual fixing in Tokyo is 9:55 a.m. Tokyo time, and so you'll have 9 a.m. is the opening of the markets, Nikkei and stuff. So anywhere from 9 to 10 a.m. Let's say there's probably going to be Tokyo time. There's probably going to be a lot of stuff going through, but it's we've seen them also go to the London fixing in the past out of experience. So yeah, I mean, yen is probably going to move into the end of the month. Which way?
Yeah.
Wet finger up in the air this time, because with all that's happened in the bond markets, in the equity markets, even in yen moves as such, oil, whatever, you have to take everything into account. I really haven't got a clue which way the major flows are going to be tilted to. Yeah.
And for the rest of the world, it's also the end of the first quarter. So those end of months can be extra spicy as well, just for everyone else. But just as we said this time, it's got the added impetus of the end of the Japanese financial year. So lots in the mix for the end of month, but we've got some time until then and more central banks to come. And over to the central banks, a funny old day for the ECB yesterday. I'm going to bang our drum a bit. I don't think everyone here could have given any better analysis of what to expect from the ECB. They went to 50. I expected them to go to 50. I was 90% certain they'd go 50 the other day. I was 60-40 yesterday after the Credit Suisse stuff. And that's what they did. But fun and games beforehand, because about 30 minutes before, Bloomberg decided to drop one of their story bombs, saying that ECB's De Guindos had told ministers some banks may be vulnerable to everything going on. This was from discussions that happened on Tuesday. So an opportune moment for them to drop that story. I suspected yesterday it was less sources, more we're going to drop this now 30 minutes before the announcement. And a lot of people then started thinking maybe it's a bit of a leak, a bit of a drop to say that they may not hike as much as expected or even pause. Bloomberg are notorious for doing this sort of thing, dropping headlines in to try and get a market reaction. And as we know from the final event, that turned out to be the case, that there was no worries about what the ECB were going to do. So they hiked by 50 pips. However, what changed in the statement is that they took out any language signaling future rate movements, i.e. there was no we've hiked 50 and we see the need to do further hikes or anything like that. That language came out. Two reasons for that, potentially. One, the worries that are happening over the banking stuff going on. And two, because Lagarde, if you may recall, a week or so ago, got a bit of a telling off from one of her governors. I can't remember who it was, Centino or someone like that, saying it wasn't appropriate, didn't think it was appropriate for colleagues to pre-commit or give advance warning of future rate increases or rate moves. This was obviously in response to Lagarde months ago telling us to expect 350 pip hikes. So she pulled away, and the ECB have pulled away now from saying what they're going to do with the further path of rates. They moved inflation expectations higher, lower in the headline for 2023, and I can show you those here. So looking at HICP, so for 2023, we're now expecting 5.3 versus 6.3 prior, but in the X's, they've all gone up. So 5.3, 4.2, 4.2 to 5.8, 4.6, 4.6. So core measures are expected to be higher this year, and that's what they will be targeting a lot in their policy decisions. But on that, going back to some of the comments coming out from Lagarde, one thing she did say, probably the biggest pointer to further rate hikes, she said that if the baseline persists, i.e. where they think inflation, where they think their forecasts are and everything else persists, when the uncertainty reduces, i.e. all this banking stuff, we will have a lot more ground to cover. So that was pretty much the most hawkish comment she made during the whole presser, that once we're over this hump, they will get back to a hiking path. However, she tacked on the disclaimer, this is a big caveat. So keeping her bases covered always round. Regarding the banking stuff, she went to some lengths to make sure that everyone knew that monetary policy is separate pretty much to financial stability policy. And she said they stand ready to respond to preserve price stability. The banking sector is currently in a much stronger position than in 2008, and the ECB has extensive facilities to react to stress if need be. So, as I say, making it clear, they were hiking for the inflation side of things and the economy side of things. They have other tools to deal with any stresses from banks. And as expected, that has translated over to Fed expectations, which we'll talk about in a moment. Then during that, she said that 3 to 4 board members did not support the decision, the usual doves this is going to be, and those dissenters wanted more time to monitor the situation going on with banks. Doves are going to dove whichever way you look at it. Then, as usual, we got the usual sources drops afterwards. And Reuters sources said ECB policymakers only agreed with the 50 pip hike after the SNB threw a lifeline to Credit Suisse, and that the debate was between a 50 hike or keeping rates unchanged, and no discussion of a 25 pip hike. Other sources out further on said the ECB was said to have feared ditching the 50 pip hike, as it may have panicked investors. So a lot of indecision and a lot of fishing around by the press there as to what went on in those meetings. I guess this is going to be one time we'll have to wait for the minutes to get the full story when they get issued in a couple of weeks. Now, because of all of that, all the some of the big banks have been tipexing out their prior forecasts made not days ago. Goldies now expect the ECB to raise rates by 25 pips in May versus their prior estimate of 50 pips, which was hiked at their last call. They now see a terminal rate at 3.5% from 3.75. Morgan Stanley was also one to raise their May hike estimate to 50 pips, and now they've gone back to 25. They see a terminal rate of 3.75 versus 4% prior. And as is ever the case, the floodgates are open. Now we're over the ECB meeting, and every ECB governor that can grab a mic is doing so. ECB's Muller said that he wouldn't want to forecast the next rate decisions. There's no sign yet of persistent inflation pressures easing, and the latest inflation forecasts assume more rate hikes. ECB's Villeroy said, priority is to fight inflation. We sent a strong sign of confidence, and that we decided to do what we said we would do on rates. Simkus said we must remain cautious regarding future assessment. Still believes this wasn't the last interest rate hike. The terminal rate hasn't been reached. Inflation risk balance remains on the upside, and wage pressures are gaining more strength on core prices. Muller was out again. No signs of core inflation abating. Too early to conclude that rate hikes can stop. And Kestrel Casimir, one of the hawks, need to continue with rate hikes, but no need to speculate about the decision in May. The ECB is not at the finish line. So overall, one could call it a dovish hike, but there is plenty to say that they will continue hiking once we get over this banking mess, and that there's no further problems coming from that. But they are looking a bit more cautious about things right now. And as said, that taking out of language from the statement about the path of hikes puts a bit more uncertainty, but it also gives them a little bit of cloud cover, a little bit of breathing room. If they need to pause, if they want to pause, it won't be such a shock to the market. So guys, what do you think? Stel, you thought they might not go a 50 yesterday. Did that surprise you?
Yes, but yeah, I don't know what to say. I thought they wouldn't because of the the whole situation. They might try to calm things down, but and that actually shows in the discussion that they told us that they had between 50 and nothing. So me saying 25, I was actually I couldn't be more wrong. But anyway,
yeah, but it's not about being wrong. You know, we all make calls and have our views and whatever. It's about and the reason I think it's important to say the reason we give this analysis and our views is because that's where we potentially see the balance of risks.
yeah,
For our own trading. It's not just to say, hey, I was right, I was wrong. It's I'm trading. I need to know where my risk is, and my risk, I think, is if this happens, that happens. So there's no right or wrong in all this stuff, is there?
that's true. That is very true. You know, I guess they must think that the situation is a lot better than I think it is, or they must know it is a lot better. I hope they're right. You know, central banks are always, unfortunately, acting based on yesterday and not based on what could be happening tomorrow. I hope they have all the information they need and that they don't need to make any panic moves going forward. But yes, I was surprised.
Yeah. Okay.
Well, I think Stelios said something extremely important there at the end of what he said, is that they are acting on the past and not on the future. And it came exactly, and Lagarde actually said exactly that. I mean, the projections, they were done somewhere between the 15th of February and the 1st of March. I mean, nothing has been decided after the 1st of March, and yet the meeting result is on the 16th of March. So they are already de facto 2 weeks behind the curve for a starter, 2 weeks to a month. I think actually it was a bit strange, the comment. It was 50 or nothing, because we didn't want to send the wrong signal. I understand it for the 50, but I quite don't understand it why they would not even discuss the 25. I really I'm in between two seats what to think. I think the move that we saw later on, euro is holding pretty well, because they naturally they closed the gap as well with other central banks and with the FOMC, the Fed, by raising 50 BPs, and perhaps sending the message to the market that we are not worried. That's probably the strong message behind it. But then I must say it's a meeting where I come out of that meeting and I'm not wiser. I'm going to be very honest. I'm not wiser after this ECB meeting, really, and I don't really know what else to say. Okay. The one thing is that by not committing to the future rate path, they just put themselves exactly where the Fed is and where you name it, Bank of Canada, RBA, whatever. They are completely data dependent. So should we. That we have been. I've already been saying that. So should we. We should be data dependent right now. And if you look at the dollar move that we had overnight, to just compare it, it's because of the US data were a little bit weaker, and we had those it's not even news. It's the accountant of the Fed saying that they actually done QE over the past 2 weeks or 3 weeks. But yeah, I mean, based on the Fed, and we can see it on some of the crosses, the euro crosses haven't really moved at all. If you look at euro sterling, same as yesterday. You look at the Euro Aussie, we were there. Euro Canada, we were there. Just to name those few. I'm not looking at the yen because the yen is living its own life. But I think the market equally came out of that meeting saying that we haven't learned much.
Yeah, no, I agree with that. And I think it's twofold. I think I can understand the 50 or pause and not 25, because 25 just muddies the water. I think you're saying, well, we're acknowledging there's problems, but we're still going to hike. So you either draw the line, I think, and this is what I think they did. They drew the line and said, we're hiking because we've got inflation problems. That's our goal. So on that front, nothing has changed. Inflation is still high. Inflation is still sticky. And if they pause, they're more acknowledging that there's a bigger problem with the financial stability side, which is what they don't want to do, because that then, I think, sends the wrong message to the markets. And that's what I think they were worried about. And, I've been saying for the last few days, I was expecting them to draw a line between monetary policy and financial stability, and the fact that they've spent a decade plus putting together all these tools, regulations, everything to combat these sorts of incidents, and they've got them ready in the backpack. And the Fed have used theirs, the S&P have used theirs, and the ECB have got theirs to use if they need to. And I think they were very clear in drawing that distinction that monetary policy is for monetary policy reasons. Financial stability tools are financial stability reasons. And as I say, I think that has transposed over to the Fed, because now Fed rate expectations are back on a 25 pip hike, which again we'll talk about in a moment. But we talk around it, we analyze it, we give our ideas. At the end of the day, what happened in prices? Well, what happened in prices? We've fluffed around up above, down below the 106 handle, and now we're sitting here. What has happened? We've had 2 banking crises in a week. We've had an ECB meeting, and we're still in the 107, 105 box. That's all I need to know. Okay, we haven't gone up to 108. We haven't gone down to 104. Everything that's transpired over the last 3-4 months, give or take these moves here, we're in this range. And until something significant happens, I don't see any reason why we break this range. The Fed might come out hawkish next week. Fine. Can we break 105? So for now, when you're looking at something like the euro dollar, you can't come into an ECB meeting, you can't come into a Fed meeting and think you're going to get 300-400 pip moves out of this, because history over the last few months says what doesn't matter what's been thrown at the euro, it's stuck in its range.
So Brian,
yeah,
can I interrupt you just for 1 second, because we had this ECB supervisory board meeting going on this morning, and they say everything's cool. There's no contagion to the Eurozone banks from the latest turmoil, and they include Credit Suisse. They were told at a meeting exposure to Credit Suisse is immaterial, so everything's fine.
Guys, this scares the crap out of me. I don't know about you guys, but seriously, they cannot claim that there is no not contagion, but there is no dependence, and everything is absolutely fine. Everybody knows that, you know, banks hold each other, banks' debt, and, you know, everything is so linked. Yeah. They just cannot come out and say, if they, you know, seriously, listening to these guys saying, oh, everything's absolutely perfect, there's no problem, I'm thinking, shit, there's a lot of trouble. You know, and they're trying to hide it.
Yeah, Stelios, I think calm down. They have to say this because it's Friday and they want the people to have a good weekend.
Yeah, that's true.
On Sunday night. Don't worry.
That's true. It just gets on my nerves, man. Seriously, when something so obvious gets denied. Anyway, carry on. It's okay.
But the thing is, as I always say, I mean, everybody is probably wrong and right at some time. The only thing that matters to me is really how am I going to trade it, because they're all wrong anyway, and we are all wrong anyway at some stage if we start to think too much about stuff. So why just take it as a trade, and the rest will probably resolve itself or show.
Yeah, no, very much so, very much so. All right, well, we'll go a bit deeper into the prices and what's going on in the markets in a moment. We'll just crack through some of the other bits and bobs. US data was out yesterday, and on one hand, you could look at this data and think, well, the data might be enough to put the Fed into pause, depending on what you want to look at. So the Philly Fed came out bad, following the Empire. That was another poor manufacturing number. So that's the second of the month that's come in negative. Look at that, employment minus 10.3% versus 5.1% prior. We'll have a quick look at that because I'm not sure if we've seen a negative number from that for a while. Oh, we did see a little one. Where was it? Wherever that is, back in December. But it hasn't been since the 2020s that we've seen big negative number like that. So maybe something there to keep an eye on the employment front. But we know manufacturing has been softer than the services part of it. Price pressures easing a touch there as well, but maybe not too great. But overall activity in the orders down as well. So not a good read in from that. Conversely, jobless claims still ticking along, nothing flagging any worries there. 192 running around that sort of 190, 200, 210 mark. So nothing to worry about there. But on the housing front, a good jump in February, both starts and permits coming in much higher. Decent, very decent beats there for those two. So maybe some of that early year positivity we saw in the NBA filtering through into these Feb numbers. So again, we're looking at maybe different parts of the economy perhaps running at different speeds. Again, this may just be some new year pickup, you know, possibly from recovering from a lot of the weather related issues going on over there. We need to keep an eye on it. But as I say, a mixture of data coming up through that yesterday. Now, as I was talking about the Fed expectations, that they've been all over the shop this last week. As we know, everything going on with the banks and whatnot, they've been up, down, pausing, cutting, whatever. We're back on the 25 pip expectations now. Probabilities are at 90% that we see the Fed doing a 25 next week. In terms of the banks, it's been said that JP Morgan, Morgan Stanley, and a lot of the other big banks are going to be putting up to $30 billion in deposits into First Republic. However, a bit like we heard with SVB, the First Republic bank executives apparently sold 12 million in stock in the months before the crash. Asked some questions there. And something I'm keeping half an eye on as the headlines pop up. Charles Schwab has been under the cosh a bit in the US, had a lot of money being pulled out. That's been put into a number. Apparently 8.8 billion has been pulled out from prime funds in 3 days. So probably a bit like Credit Suisse, Charles Schwab is under a bit of a battering over in the US. We need to keep an eye on that one in case A, it turns into something, or B, it is something that we don't know about, one of the known unknowns going on in among the banks and brokers and whatnot. All of this hasn't stopped the S&P from affirming the US at its AA+/A-1+ B2G sovereign rating. They say the outlook remains stable. And on the geopolitical front, Politico report that Chinese companies are shipping rifles and body armor to Russia. Again, that goes in the geopolitical risk pot to keep an eye on everything going on over there. Oof, lots of headlines, lots of news.
Ryan, can I add one more comment regarding the banks that we were talking before?
You can, mate.
We have to remember, banking is a business of confidence because of the nature of the fractional reserve banking. You know, the banks never hold as much money as they. If everybody comes on and says, "I want my money," they don't have it, right? So it works on confidence. So on every occasion, the banks and obviously the central banks and anybody who's related to them will try to appease people and to bring back confidence. I know it. I've seen it with my own eyes when I was at the Merrill Lynch. The walls were crumbling, and this management were saying, "Oh, everything is fine. Liquidity is good." So, I just have to say that this is how the banking sector works. It works on confidence. That's why I think the first reaction they always have is, "Oh yeah, everything's fine. Don't worry." How many times have we seen that? Right? We saw, what was it, First Republic Bank a couple of days ago saying, "Oh, our situation is fine." and clearly they're not, right? All of them, it's the same. So that's why I always take these comments with a pinch of salt, a large pinch of salt, actually.
Yeah, no, I agree with you. And I think it's why I've been reluctant to get sucked into this is the end of the banking world, zero hedge type.
I don't think it's the end. I really don't think it's the end of it. But I think the problem is a lot deeper than they tell us it is.
Yeah, and you may think this is a bit of blind faith, but as I've been saying, the central banks and regulators have spent the last 10+ years putting all these things in place to mitigate any of these problems. And I actually trust them that they can do it, and they've shown it. The Fed showed it, the Treasury showed it. They stepped in on a Sunday, shored everything up, put in the backstops, quick as you like. The S&B and FINMA maybe were a bit slower to jump to the gun, but they're all standing there ready. They were all on the phone, the Bank of England, you name it, ECB, all speaking to each other, making sure, A, what's going on, but B, that they're ready to jump in and use the tools needed. And I think for us trading, if you look at it from that side, that's where your trades come in. That's where your opportunities come in. Because if the market gets too fearful, and it goes really too far on its fear, look at US yields as one instant for that. If you feel that the market has gone too far, then there's a trade. You try a fade because you think, well, what is the real outcome? Is the market overly scared or is it not? And I had a couple of those trades this week, nothing big. The S&P earlier this week, euro dollar yesterday, and by and large they paid off because the fear tends to be overblown, and I love trading fear when it's overblown. But yes, so here we are, and we'll look at the yields as well. There's the 1-year yield that we've been looking at, a bit of a marker just for how expectations are going again for central banks. And we still can't get back above this Fed midpoint. Again, this is not a technical level. This is just a sentiment level. when last week we finished with Powell, we were sailing high and mighty up above 5%. Everything was tickety-boo. The rate ceiling was going higher. Fed hikes were happening, so on and so forth. It's a completely different picture the way we're looking to close this week. It's going to be hard work for the market to trust again that the Fed is going to be taking rates that high and keeping them that high for longer. And so from that, that's going to impact what we see in the dollar. Talking about euro dollar, it doesn't at the moment, doesn't matter what happens, we can't break this bloody range. So on one aspect, that gives us a range to trade. But also pairs like dollar yen, it's going to find it tough maybe to get back up to these highs. It's still struggling to hold on to highs. We made that big, massive low all the way through the prior lows yesterday. And even now, the bounces are pretty limited up towards that 134 area. So I think there may be some more price discovery to happen on the downside. I'm not confident that we've bottomed until I see the price action show me that we've bottomed. Maybe another move down towards these lows, but maybe not coming down as far, maybe 132, something like that. That will give me at least a bit of conviction that this low is being protected and the market's had enough for now. But while we keep making new lows, it keeps the downside in play. We've got a bit of a trend developing now following the big drop down. So for me, it's 50-50. And I'm a bit neutral on this one. Usually I've got a bias, but right now I'm a bit neutral. Have to see how the Fed react next week. I think they stay on their rate path. Whether they take a bit of more cautious note based on the data that's been out recently, that's maybe a bit softer. I don't know, but as I say, I think it's going to be a bit of a struggle to see us making any massive new highs unless something really changes or comes out. What do you guys make the dollar yen at the moment? Obviously, we've got we've spoken about the end of fiscal year stuff, which might just make it a bit of a washing machine. Have you got a particular bias at the moment?
No, I'm really not planning to do anything else than short-term stuff right now. The only thing noteworthy is that, because it's just trading risk sentiment, and again the yields. If you look at the US 10s and you overlay dollar yen, you're probably going to find exactly the picture, the same picture. So and then a bit of probably S&P in there. I'm actually surprised that it came back that easily above 133, because also with energy lower, that's another factor that should be in theory supportive for the yen. But really, I think I have the impression that we're firmly in the grip of the algos right now, the correlation algos, and that makes it very random for me. The one that I'm keeping an eye on today is that the daily cloud, and it's the last one. It's really going down for a while. The top of the daily cloud is around 132.55, and if Japanese accounts want to trade it, I'm not saying the corporates or whatever, but if the Japanese accounts want to trade it, they're probably going to look at that 132.55 zone for the close of the week come Monday opening. That's the one that I'm looking at. The rest is just very very volatile, as we know, on the crosses as well. I'm really not interested in anything more than short-term jobbing in these markets. Yeah, going into the end of the fiscal year, I really don't know. And then we have Ueda up. I still think he's not going to be the big reformer, but there will be some form of reform, normalization, rethinking the framework. Everything's possible, doing something about the ETFs or the REIT purchases. It's all possible in the pipe, but there's a lot of uncertainty right now of what really is to go is to happen on the yen on a more trendy basis. I mean,
yeah. I want to look at the vols quickly, because one of our guys, Grasshopper, in the chat room made a very wise, astute post comment about the VIX and how over the course of his trading these last few months, how the VIX has been a good indicator of volatility and what to expect from markets. And I want to show you guys and girls this. No affiliation with this mob, but they do have this handy widget on their website. You can see it there, centuryderivatives.com. And there's a button down here you press for vols, and it brings you the vols. And this is something, it's a bit like looking at the weather forecast. Okay, I look at this 1 month at the money option vols, and these percentages, mainly for the majors, tell you how volatile things are possibly going to be, and it gives you an indication how a market may move based on different headlines. So anything that's sort of sub 6%, you're getting into low vol territory. Things are quietening down. Prior to the virus, we were just coming out all the GFC stuff and everything. Euro dollar vols were down at sub 4%, down to 3.5, 3.6%. The market was moving 20 pips a day. It was very quiet. It was very boring. But now vols are much higher. And you also get, they're running pretty much around the same areas. Dollar yen is still quite higher vol than cable and euro dollar. But it's this sort of thing that shows you the differences between them can indicate how far a pair may move compared to another one. So I say a lot about the difference between cable and euro dollar, how cable tends to move more than euro dollar, even if they're both going in the same direction. If euro dollar's spiking 20 pips on a headline, cables may be doing 30, 40 pips on the same headline. And that's purely this difference in volatility, liquidity as well in different pairs comes into it. But this is a good weather forecast, if you like. This tells you, if you're trading, even if there's nothing going on, that how prices may move. You may get 20, 30, 40 pips out of a small headline or a small piece of data, whereas with lower vol, you might only get 5, 10 pips. So this is something you should have in your arsenal just to keep an eye on. It's nothing you can actually trade on unless you're actually trading options, but it just gives you an overview of markets and how they can possibly move and how volatile they can be. And just one other thing I want to come in, because a couple of guys in the chat room was asking about the options that we put up in the chat room, and just how options work, what we do with them, that sort of thing. And got this post here, which the K-Meister put his good hand to as well a while back. So if you want to learn about a bit more about options, how they affect markets, what we look at them in terms of price movements. For example, we got a big option expiry today at the 106.90, 107 level in euro dollar. Over 4.5 billion is rolling off there. We're quite a way away, but if we get up near there over close to the expiry time, we could see the price glued around that area. And what I look for in options when we get big numbers like this, if a price gets glued to a particular level, potentially due to an option, but prices are moving elsewhere, and this one's not following or playing ball with what everyone else is doing, that potentially opens up a trading opportunity for some catch up after the market expires. So if you want to have a look at how options work, please have a look at that post there. Right, Kay, do you want to have, or Stel, or anyone? Let's open it up. Anyone can have a look at the charts today.
I'm good. If Kay wants to take it, that's fine.
Well, you want to comment on anything else? Still, yeah, okay. About this QT and non-QE, have you seen this news coming out yesterday? It's not only zero hedge. I've seen it elsewhere. That the bank, the Fed injected like $300 billion, and by that fact, raising about half of the QT they have done so far. I do think it had a bit of an impact on the dollar overnight as well. When that news came out, when people started to talk about it. Do you have any comment about that?
Well, about the non-QE that they're doing?
Yeah.
Well, I was discussing this with my brother this morning. He was, by the way, works at Deutsche, and yeah, he's been in the markets longer than I have. He's older than me, but anyway, you know, we were both saying that it's becoming clear that the market cannot function with high interest rates. It's becoming clearer and clearer, and not high interest rates for long. You know, the Fed has raised to, you know, almost 5%. The ECB is at 350. And which historically, by the way, is not high rates. And we are already talking about, you know, banks failing and risk of contagion, and etc. So I fear that this is something that the central banks will need to keep doing more and more. So they do QT, they hike rates, and then they just revert as quickly as they can. So you know, all these measures like this. Effectively, you know, this non-QE that we're talking about, which really is QE, they're going to start appearing more and more as rates go higher. And this is an automatic break for rates.
Yeah.
And there's the problem remains, what do you do with high inflation if you can't really keep rates high? That's what the markets, what the central banks have driven this themselves to, and I don't know the answer to that. And also, I'd like to also say one more thing before I forget. The things I say, it's not to scare people. I'm just using my experience of what I've seen to make some deductions for myself. Obviously, you can believe them. You can, you know, do whatever you want with them. I'm just sharing my views based on my years of trading, and you know, I've been around.
So, are you saying banks have forgotten how to bank in high rate environments?
Yeah,
well, not forgotten. They can't at the moment. That's the problem.
Yeah, I mean, I think SVB and the crew is a perfect example, right? That they don't know how to trade higher yield environments. And by the way, Ryan, on the when you were showing the options as well, it's also I just would like to add, it's also normal that vols are higher in the rate environment that we have, because swap rates are moving faster in a higher yield environment, which is more volatile than a low yield environment. So
yeah,
if vols right now, FX vols right now would start to tank, then I think it's better that we change jobs, because in a high yield environment, we should see higher volatility. It's just a normal fact, you know, because the swap rates are going to be bigger and more volatile as well, and they come into account for calculating volatility and stuff like that. So I just wanted to add a quick word. I'm not going to take too much time, so I'm going to rush through a few things. Cable. It's in this channel, but as people in the room know, I kind of like, and I call it the elasticity, but I don't even know if that's a real term in the market. We used to use it, the old market making crew, but and it looks quite okay. The rebounds are okay in my opinion on this cable, but fact is, we can't break above right now. So there's a clearly defined zone here, which is 121.80 up to 122, the figure where we stopped already 3 times in this cable. And I reckon that's going to be a decent level to watch for the close of the week, if we are above or below. If we're below, I think we are in this short-term range right now, about about 120, 122, which probably in cable it's going to be wider than Ryan's 105, 107, but that's basically it, right? I mean, it's roughly the same kind of range. In the sterling, the 105 is probably going to coincide more with a 119.5 in cable, or even low 119, because of the less liquid nature of the cable right now. But I do kind of like picking them up on small dips, especially when we see the data that we have seen out of the States, which are mixed, but showing some slowing, right? Especially on the manufacturing sector. We have seen the retail sales giving back stuff this week as well. I don't know if the dollar may be somewhat more under pressure just to close the week. And also with that QE stuff or less QT thing. Not going to go over the euro dollar. That's Ryan already said enough of it. I'm going to go have a quick look at what our emerging markets are doing. So we had this double tryout in the dollar makes above 19. We never reached really the real danger zone, in my opinion, which is 25.30, 19.25.30, and then we started to come back below. Also with the dollar losing some of its steam, the less immediate stress in the banking world. Let's put it that way. I mean, the market, the stress is not gone, and there can be more bodies falling out of the cupboard, and there likely will be. But the market is very sanguine, and the market is suffering from globalized Alzheimer as well. So the market tends to forget really quickly when things were bad and once it get less bad, they're quickly to reverse it. And the mix is really one who is trading very, very much on sentiment because of being such a high yielder. And we've seen the mix picking up steam again after the worst was over. Yeah, sold a little bit there on the break back below 19. I'm looking at this 1850s to be a first serious support area. A bit of traffic in this zone. This is going to be one to watch for the close of the week, I think. If in turn there's a lot of stress coming back into the market, then we shouldn't be short in this one, because then we could really put a test on this level up there. But in the meantime, I think with a little bit less stress, a bit better equity markets as well, this may have a chance of doing another 0.5 to 1% lower to close the week, I think. Rand is a different animal, completely different animal, suffering from its own woes. And there, I think, as long as the low 18s hold, it's going to stick in this range for now. Trade the stress or the less stress. So that's why your 1845, 1850 comes in cap. So we have the range there to play inside if you like. The dollar yen back to, yeah, I was looking at dollar China, but I really can't see too much. It should have jumped a little bit. It did just a little bit after the RRR cut, but we're still staying below this 91, 90 and a half, 92 and a half, 93 zone, where it's probably, this is probably the gateway back to 7. If you stay below, there's a chance to just range trade for a while. There's a lot of range trading going on, in my opinion. Right, whatever. What else?
Dollar yen's getting a bit of a pace.
Oh yeah, dollar yen's getting a slap here. What's happening? Something come out, or
I can't see anything.
Is something on this OECD thing? Because I saw OECD came out with a report.
They've raised. I don't know. Yeah, they've raised.
Could just be S&P coming back. Oh, the US 10s are back below 350. That's the other one. It's gonna be. It's so. Everything is done by the correlation algos, I think. So in the short term, dollar yen, well, we're getting there. This 132.55.70 zone, we're trading on it. That's going to be the immediate zone to monitor, in my opinion. If we get back below, why not retest this low? But I don't think that on the risk front, there's too much justifying for a much lower dollar yen right now. Top side, yeah, well, where we stopped again in the last couple of tries, 133.80. That's our zone. And then on the dailies, as I showed you, Ryan showed you, the 132.55 is the where the daily top of the daily cloud lies right now. I wanted to have a quick look at crosses now, that assuming that the the banking stuff is a bit behind us. We have to look. One of the interesting ones is Euro Canada, especially because the Bank of Canada kept its hands still and the euro still raising rates. And we can see that once the dust has settled, we're still in this upward channel. So I'd say a move close to 145 could even stretch it to this 144.5 perhaps, but that would break the channel. 145 should be coming in as a support in my opinion, and we might have a chance to crawl back up above 146 towards those higher levels. That conditionally to the fact that crude is not putting in a big reversal. We've got a little bit of a similar picture, although the Aussie is stronger. No, that's the Aussie Kiwi. Where is the Euro Aussie was on the same picture. Got a little bit of a similar kind of picture around 159 here on this Euro Aussie. We are below. Keeping an eye on this 158.5. If that holds, then we are going to be a little bit of a range. But keep an eye on the 159. I'd say for a close of the week. That could be a bit of a decider starting the next week without really taking a big directional view here. I don't know. Aussie looks a little bit better bid, but then the Kiwi is even more bid right now. And that brings me to what I wanted to show as well, is this Aussie Kiwi. I don't really like the fact and how, especially Kiwi is bid. We've broken back above, and at that stage the line in Aussie Kiwi was around 107.40. But it's too easy to retest it, and trend line is going down, so it's a bit dangerous to go and play it. Fact is that we are back below 107.40, and I don't particularly like it. I've got a very small leftover. Luckily, took some money off on the way up, and I'm about to abandon ship here, and that's just because of this one. The Kiwi really rebounded strongly above this 62 line, which was always been a bit of a line of weakness or strength, and it's really rebounding very, very hard. This 61.95, 62 is going to be the close of the week measure point, in my opinion, and it's well back above. So even with slower numbers, with a bit of risk on the current account, Kiwi hasn't really suffered for too long. Must be a bit of a risk play in there as well. But yeah, that is what is now weighing on the Aussie Kiwi as well in turn. So keep an eye on this 62 figure. Top side 62, 3/4, 63. The figure is going to be a big zone here. If ever Kiwi gets back above 63, I think it could be a little bit of an explosive one. But yeah, in the meantime, keep an eye on the 62. Anything else you guys want to look at before we leave? Quick look on gold here. I think it's pretty big, quite big actually. This prior high 38, stretch it to 40. That's the gateway back to 1960, in my opinion. I'm jobbing it. But really fast stuff. I'm jobbing it from the long side for as long as it's above 1915 here. Yeah, it's the strong brother of the two, because when the economic data are sluggish, gold is always going to do better than silver. When the rest of the data show that metals should be underpinned. So this one is in a range here. 22.05 silver, 22.25, call it 30 last spike. That's top end of the range. Downside 21.5 down to 21.30. That's the underside of the range. I'm not planning to do much with this for as long as we are in this range. And that closes the votes for me, Mr. Ryan.
Thank you very much.
And I really don't know. I really don't know why Dorian is getting it.
It's getting a bit hosed, isn't it?
Yeah.
Ours is not to reason why, ours is but to sell and buy, as they say. One of you kind folks asked about going over next week's events. We'll do that on Monday, as we often do. I want to get over this week first, let alone looking at what's happening next week. Just to round it off, we have got some further US data today, industrial production coming out, and the first flash number for the University of Michigan Consumer Sentiment Survey, and those all-important inflation expectations. So that could be a bit of a mover, depending on the market's mood later on this afternoon. As ever, I'd like to thank all you viewers for coming and supporting us here on the Flow Show. I hope we are doing a good job for you. If we're not, if you have any ideas, things you want changed, things you want to see, please
you'll get a full refund if we're not.
Yeah. Yes, send all your complaints to Steve if you don't like what you're getting. But seriously, if we're open to suggestions. If there's things you want to see, different formats, we always got our ears open. So please let us know. But thank you for coming to the show and supporting us, and always thank you for the company of the two greats, Stel and K-Man, for everything they put into this as well. Much appreciated, certainly by me and everyone else. Take a bow, guys.
Thanks, everybody.
TGIF, have a nice weekend. Trade safely.
Yeah, thank you, everybody. Have a great weekend.
Bye-bye.